Hello and welcome to Daily News Simplified, where we take up important articles of the day from the newspaper and discuss them in detail as per the demands of Civil Services exam. Articles covered today are displayed on your screen and their notes in PDF and Word format are provided in the description box down below. Without further ado, let us begin. Starting off with the first article of the day, which appeared in page 1 and 9 of today's Hindu newspaper. The article reports that the Supreme Court has given the Securities and Exchange Board of India, or SEBI, time till August 14th to complete the investigation into Adani Group's allegation by a report of Hindenburg. This Hindenburg's report on Adani Group's financial health led to fall in its share prices, which led to market volatility in the first quarter of the year. This negatively impacted the macroeconomic stability of financial markets in India and which have negative implications on Indian economy in general. Now, UPSC in GS paper 2 has given statutory, regulatory and various quasi-judicial bodies. Further, in GS paper 3, Indian economy and issues related to planning, mobilization of resources, growth and development and employment is covered. From previous year question in the year 2013, we can see that a question appeared on merger of SEBI and IRDA. Thus, in the scope of today's discussion, we will cover stock markets and the laws that governs them. Further, we will take a look at SEBI's, its structures, powers and mechanisms for appeal against its orders, etc. Moving forward, we will take an overview of the functions of SEBI with respect to curbing market volatility, monitor fundraising, regulating of stock exchanges, and preventing the markets against fraud. Further, we will take an appraisal of the work done by SEBI and its achievements. Then, we will discuss in details the challenges that are associated with stock market regulations. In the end, we will discuss a way forward before concluding this discussion. Now, what are stock markets? Stock market is a place where shares of publicly listed companies are traded. The first is a primary market, where the company floats its shares to the general public through a device called Initial Public Offering or the IPO, and the company offers this IPO in order to raise capital. The second mechanism is called the secondary market. Once a new security has been sold in the primary market, they are traded in the secondary market, where one investor buys shares from another investor at a prevailing market price or whatever the price both buyer or seller agree upon. The secondary market or the stock exchanges are regulated by a regulatory body. In India, both primary and secondary markets are governed by Securities and Exchange Board of India or SEBI. A stock exchange facilitates stockbrokers to trade company stocks and other securities. A stock, it may be bought and sold only if it is listed on an exchange. Thus, an exchange is a meeting place of stock buyers and stock sellers. In India, primary stock exchanges include Bombay Stock Exchange or BSE and the National Stock Exchange or the NSE. Now, let us take a look on the laws that govern the securities market in India. It is primarily regulated by 4 key laws. The first is the Companies Act 2013. The second is the Securities and Exchange Board of India Act of the year 1992. The third is the Securities Contract Regulation Act or SCRA Act of 1956. The fourth and the final act is the Depository Act of 1996. The framing of these laws reflect the evolution and development of capital market in India. Now, let us discuss in detail about Securities and Exchange Board of India or SEBI. First, let us discuss its structure.
SEBI is run by its board of members. This board consists of a chairman and several other full-time and part-time members. This chairman is nominated by the union government. The others include two members from Finance Ministry, one member from Reserve Bank of India, and five other members which are nominated by the union government. The headquarters of SEBI is located in Mumbai and regional offices are located in Ahmedabad, Kolkata, Chennai, and Delhi. The SEBI Act empowers the SEBI to protect the interests of investors and regulate and promote the development of securities market in India. SEBI was given the power to register intermediaries like stockbrokers, merchant bankers, portfolio managers, and it regulates their functioning by prescribing eligibility criteria, conditions to carry activities, and periodic inspections. SEBI also has the power to impose penalties such as monetary penalties, which includes suspending or cancelling the registration of market participants. The Securities Contract Regulation Act or the SCRA empowers SEBI to recognize or de-recognize stock exchanges. It also prescribes rules and bylaws for functioning of stock exchanges, and it regulates trading, clearing, and settlement on stock exchanges. As part of development of the Securities Act, Parliament has passed Depositories Act of the year 1996, and SEBI has made regulations to enforce the provisions of this act. This act introduced and legitimized the concept of dematerialized securities or DMATs. These dematerialized securities are held in electronic form. Today, almost all the listed securities are held in this DMAT form only, and SEBI sets up the infrastructure for doing this by registering depositories and depository participants. The depository regulations empower SEBI to regulate functioning of depositories and other participants by prescribing eligibility conditions, periodic inspections, and power to impose penalties. Appeals against the order of SEBI and stock exchanges can be made to Securities Appellate Tribunal or SAT. SAT comprises of a presiding officer and two other members. Appeals from this Securities Appellate Tribunal can be made to Supreme Court of India. Now, what are the functions of SEBI? Let us take a look. Functions of SEBI includes: first is to curb market volatility. While SEBI does not interfere to prevent market volatility, exchanges have circuit filters, both upper and lower, to prevent excessive volatility. However, SEBI can also issue direction to those who are associated with the markets and has powers to regulate trading and settlement of stock exchanges. Using these powers, SEBI can direct stock exchanges to stop trading both totally or selectively. It can also prohibit entities or persons from buying, selling, or dealing in securities or from raising funds from the market and being associated with intermediaries or listed companies. The second function of SEBI is to monitor the fundraising activities. The Companies Act, which regulates companies incorporated or registered in India, has delegated the authority to enforce some of its provisions to SEBI. These authorities include regulation of raising capital, corporate governance norms such as periodic disclosures, board composition, oversight management, and resolution of investor grievances. Specific regulations that are enacted by SEBI from time to time includes regulation of fundraising activities, ensuring that the companies followed corporate governance norms, and regulation of entities involved in fundraising activities such as merchant bankers, etc. The third function that SEBI discharges is regulation of stock exchanges. The Securities Regulation Act or SCRA has empowered SEBI to recognize and regulate stock exchanges. Powers of SEBI in this regard includes declaring an instrument as a security, regulating the listing of securities like equity shares, the functioning of stock exchanges, which includes control over their management and administration. It also includes power to determine the manner in which settlement is done on stock exchanges and recognizing or regulating clearing corporations. Further, it also includes provisions for arbitrating disputes between stockbrokers and investors who are clients of such stockbrokers. Protecting the interest of investors by creating an investor protection fund for each stock exchanges also comes under the purview of SEBI. Now, the fourth and final function that SEBI discharges is safeguarding the investors against fraud. As fraud undermines the regulation and prevents a market from being fair and transparent, SEBI has been given the powers of a civil court to summon persons or seize documents and records, attach bank accounts and properties to carry out investigations. SEBI has notified regulations to prevent two key forms of market fraud, that is, market manipulation and insider trading. SEBI also ensures protection of investors' interest by regulating the listing and trading of equity shares and other securities, and by registering and regulating institutions that handle public funds. Now, let us take a look on major achievements of SEBI. The first is the dematerialization of shares. After Depositories Act of 1996 was passed, physical certificates that were prone to postal delays, theft, or forgery were done away with. It also prevented the issue of fake certificates. Dematerialization of shares enabled electronic trading, which enabled investors and traders to work from home. The second major achievement is to introduce the faster settlement process. SEBI is credited with quickly moving from a T+5 settlement in the year 2001 to T+1 cycle settlement in the year 2022. This has enabled to bring down the settlement and trading of shares from 5-day to 1-day respectively. The third major achievement by SEBI is to introduce stronger regulations. In order to bring efficiency in the working of secondary market, SEBI has laid down specific rules and regulations for intermediaries in the secondary market. Intermediaries are now required to adhere to specific capital adequacy norms. They also need to meet certain eligibility criteria and follow a code of conduct towards investors. The fourth major achievement is to foster a mutual funds industry. The mutual funds industry in India has grown several folds over the years. Until the year 1990s, the market was monopolized by Union Trust of India. However, currently, the asset under management under Indian mutual fund industry has grown from 6.3 trillion rupees in June 2010 to 25.5 trillion rupees in June 2020, which shows a 4 times increase in the span of 10 years. The fifth major achievement of SEBI is to introduce internet trading. SEBI has allowed internet trading under Order Routing System or ORS through registered stockbrokers on behalf of its client. It has thus facilitated investors to buy and sell shares through internet on their computers. It is seen as a major advancement in trading shares at stock exchanges in India. Further, SEBI also introduced a circuit breaker system. This system is based on market volatility of individual stocks. According to this system, if a market volatility of stock crosses a certain limit, the trading of this stock is stopped for a few days so that the speculators may not take an unfair advantage. However, despite these major achievements, there are still challenges that are associated with stock market regulation in India. What are these challenges? Let us take a look. The first challenge pertains to enforcement process. While SEBI has made regulations and issued orders as a civil court, but only making regulations and giving orders is not enough. While SEBI has given orders, it has a limited capacity to enforce its orders. The second major challenge is the lack of human resources because SEBI has been unable to attract smart, bright talent inside it. In the year 2012, SEBI only had 643 employees as against thousands in US Securities and Exchange Commission. The third major challenge that SEBI faces pertains to deepening of capital market. While the total number of demat accounts has risen by 37% last year, the monthly active users have declined. SEBI has although done a lot to encourage people to participate in capital market by abolishing entry load on mutual funds, simplifying KYC norms, but it also needs to take some stronger steps in order to deepen the participation in capital market. Further, corporate debt and securitization market in India, despite numerous attempts by SEBI, has failed to attract sufficient liquidity. Further, SEBI has failed to match up to global standards. Capital markets are growing and the size of SEBI as compared to security market is not sufficient. Thus, it is unable to properly regulate the capital market. Also, SEBI suffers from a non-transparent recruitment process. The appointment process in SEBI has always been criticized because of allegation of corruption by SEBI staff and the lack of accountability mechanisms that envelop SEBI are also poor. There are other issues pertaining to regulation of stock markets. The first is that the SEBI has wide legislative and discretionary powers, which sometimes fail to do justice with the market participants. Also, SEBI has limited prior consultation with the market. Further, the securities offering documents are extraordinarily bulky, which offer little to no substantive disclosures of high quality. Also, SEBI has been unable to deal with obsolete regulations. For example, regulation on merger and acquisition are nearly 6 years old. Before concluding, let us go through a few steps that can improve the stock market regulations in India. The first is that SEBI needs to strengthen its surveillance and enforcement functions. It needs to ensure that violations do not go unnoticed, whether they are small or large violations. Also, SEBI needs to increase its human resources, both in terms of quality and quantity. It needs to significantly improve its market intelligence, technology, and talent pool in order to improve its stock market regulation. Further, SEBI also needs to work on deepening the market participation in equity by pension, superannuation, and gratuity fund, and by developing a vibrant retail debt segment. This can be done by reducing the cost of transactions in security market. Further, SEBI needs to develop a vibrant corporate debt market and securitization market, as these largely remain a part of over-the-counter market. Like its peer in Western markets such as US and UK, SEBI needs to establish self-regulatory organizations which can focus on routine decisions and thus leave SEBI to do work on more important issues. Also, investor protection and market integrity is also a key area of interest that SEBI should focus upon. Despite its young age, SEBI has done a good job in keeping the faith in sanctity of our markets. However, more work needs to be done to prevent the flow of confidential information, which is evidenced by price movement around earning, other corporate announcements, and front running of block transactions. Also, SEBI needs to work on its independence and accountability. A quasi-legislative or a quasi-judicial entity like SEBI needs to establish its independence in order to do its job effectively. If selective interference from outside were to lead to selective absolution, then the trust in market would break down. Thus, a reporting mechanism to parliamentary committee is a way forward. Furthering, development of markets is a key area of interest for SEBI. While India boasts a key world-class equity market and increasingly important bank assets, its bond market has failed to keep up. The government bond markets remains illiquid, while the corporate bond market, in addition to remain restrictive, is also largely arbitrage driven. Thus, in order to prevent further macroeconomic instability like the ones that happened with Hindenburg's report on Adani Group, SEBI needs to improve its functioning. Increasing participation of retail investors in bond market should also lead to increasing in function of SEBI. Moving on to the second article of the day, which appeared in page 14 of the Hindu newspaper. The article reports that the Union Cabinet yesterday approved an updated production linked incentive or PLI scheme for IT hardware manufacturing, and it doubled the budgetary outlay for the scheme to 17,000 crores. Now, electronics manufacturing in India has witnessed a consistent growth of 17% over the last 8 years, and this year it crossed a major benchmark in production, that is, India produced worth of $105 billion of electronic goods. Also, India crossed $11 billion in mobile phone exports, and it has become the second largest mobile phone handset maker behind China. Now, before getting into the nitty gritty of PLI scheme for IT hardware, first let us look at the importance of such topic for UPSC exam. Now, UPSC in GS paper 3 asks about effects of liberalization on economy, changes in industrial policy, and their effects on industrial growth. UPSC in the year 2022 in mains exam asked about economic growth in the recent past and asked us to explain the statement with regards to increase in labor activity. While in the year 2017, it straight away asked a question on labor intensive exports and asked us to suggest measures to make exports more labor intensive. In the year 2012, in prelims, UPSC asked a question about schemes related to manufacturing sector, such as National Investment and Manufacturing Zones, Technology Acquisition and Development Fund, etc. Now, in the scope of today's discussion, we will first cover what is a PLI scheme. Then, we will move on to discuss the key features of such schemes. Then, we will discuss why is there a need for PLI scheme. Then, we will look into the features of revised PLI scheme for IT hardware. Moving forward, we will analyze this scheme regards to its benefit and issues associated with it. In the end, we will suggest a way forward before concluding this discussion. Now, let us have a look on what is a production linked incentive or a PLI scheme. Production linked incentive refers to a rebate given to the producers. This rebate is calculated as a certain percentage of sales of the producer, also referred to as percentage of incremental sales. This incentive is calculated on basis of incremental sales ranging from as low as 1% in electronics and technology products to as high as 20% for the manufacturing of critical key starting drugs and certain drug intermediaries. Now, what are the key features of PLI scheme? This scheme is an outcome based scheme, which means that the incentives will be disbursed only after the production has taken place. The calculation of this incentive is based on incremental production at a high rate of growth. In some sectors, such as advanced chemistry cell batteries, textile products, and drone industry, the incentives will be calculated on the basis of sales, performance, and local value addition done over a period of 5 years. This scheme focuses on size and scale by selecting those players who can deliver on volumes. The selection of these sectors covers cutting edge technology, sectors for integration with global value chains, job creating sectors, and sectors which are closely linked to the rural economy. Also, the design of PLI scheme is such that it is compatible with World Trade Organization commitments as a quantum of support is not directly linked to exports or value addition. Now, let us take an overview of the sectors that are covered by PLI schemes. So far, this scheme has been rolled out for manufacturing in 14 sectors. These sectors are labor intensive and are likely to create new jobs for a ballooning employment workforce in India. The scheme for key starting materials, drug intermediaries, and active pharmaceutical ingredients are regulated by Department of Pharmaceuticals, while the PLI scheme for large-scale electronic manufacturing is regulated by Ministry of Information and Technology. The scheme for PLI for manufacturing of medical devices is again regulated by Department of Pharmaceuticals, while scheme on electronics and tech products is again regulated by Ministry of Electronics and IT. The scheme of PLI for pharmaceutical drugs is also regulated by Department of Pharmaceuticals, while the scheme for telecom and networking products is regulated by Department of Telecommunications. The scheme for PLI in food products are regulated by Ministry of Food Processing Industries. This scheme also covers white goods which are regulated by Department of Promotion of Industries and Internal Trade, whereas scheme for high efficiency solar PV module is regulated by Ministry of New and Renewable Energy. The scheme for automobiles and automobile components are regulated by Department of Heavy Industry, while advanced chemistry cell battery is also regulated by Department of Heavy Industries. The scheme of textile products, which also includes technical textiles, is looked after by Ministry of Textiles, while Ministry of Steel looks after scheme for specialty steel. In the end, the 14th sector that was added later on was scheme for drone and drone components, which is looked after by Ministry of Civil Aviation. Now, why is there a need for PLI scheme? Let us discuss it. The production linked incentive scheme was needed because the manufacturing sector has become stagnant in its contribution to country's GDP. It is only responsible for contributing about 15 to 17% of GDP since the year of 1991, that was the year of economic liberalization. Whereas there is a large number of medium and small scale industries with nearly 90% of the workforce in informal jobs. Also, post COVID, there is a need for global push in looking for alternatives to China, which is also referred to as China plus one strategy. Hence, manufacturing companies are looking for an alternative to China, and India is placed well within the scope to increase its manufacturing capabilities. Further, earlier initiatives by Government of India such as National Manufacturing Policy and Make in India have had limited success. The idea of PLI is important as the government cannot continue making investments in capital intensive sectors as they need longer time for giving returns. Instead, what it can do is invite global companies with adequate capital to set up their capacities in India. The kind of ramping up of manufacturing that we need requires across the board initiatives. But the government can't spread itself too thin. And if government can focus on labor intensive sectors, it would be helpful. However, this PLI scheme is different. Unlike previous schemes that were brought to boost domestic manufacturing, PLI scheme aims to give incentives and benefits only if the companies are able to prove that they had incremental sales over the period of next 5 years. Hence, let us discuss the need for revised PLI scheme for IT hardware. The PLI scheme for IT hardware such as laptops, tablets, all-in-one computers and servers were first announced in the year 2021. Having an initial outlay of 7,300 crores, spread over a period of 4 years. Under this scheme, domestic players investing rupees 20 crores and clocking sales over 50 crores in first year and 100 crores in second, 200 crores in third, and 300 crores in final year would pocket incentives of about 1 to 4% on incremental sales, with 2019 and 20 as the base financial year. However, industry body that represents companies had called for increasing incentives that were offered under the scheme. The first version of this scheme was a laggard, as only two companies were managing to meet the first year's target, and hence the industry called for the renewed scheme with an increased budgetary outlay. And hence, because of this, revised PLI scheme for IT hardware was brought forward. The Union Cabinet on Wednesday, it cleared a revised PLI scheme having an outlay of 17,000 crores, which is more than double of the scheme that was brought earlier. This scheme will be implemented from June 1st with a cap on maximum incentives available to participating companies. This renewed scheme could attract big global IT hardware manufacturers to shift their production base to India and would give a boost to local production of laptops, servers, and personal computers. The tenure of this scheme has been fixed for 6 years, and the center is expecting an investment of about 2,430 crores. The expected incremental production value could touch 3.35 lakh crores, and the scheme is expected to generate about 75,000 direct jobs. And in total, the employment figure could cross 2 lakhs if we consider indirect jobs. Investment made by eligible companies in contract manufacturers and for attaining exclusive arrangements with component manufacturers are also covered under this scheme. The average incentive is spread over 6 years and will be about 5% as against 2% over 4 years that was offered earlier. Companies that locally manufacture certain components, including memory modules, solid state drives, and display panels, will also get additional incentives under this restructured scheme. There will be a flexibility in choosing the base year as well. While the final policy specifics is yet to be released, it is understood that the global companies will get the maximum incentives capped at around 4,500 crores, while 2,250 crores is for hybrid, which have an element of both global and domestic entities, while 500 crores is for domestic companies. This cabinet approval for IT hardware PLI scheme is focused on expanding India's production and presence in global value chain of IT hardware. By deepening and broadening the electronics ecosystem in India, this scheme aims to play a key role in catalyzing India in achieving its $1 trillion digital economy goal by the year 2025 and 26. The IT hardware industry is targeted to reach a production of $24 billion by the year 2025 and 26, and exports is anticipated to be in the range of $12 to $17 billion during the same period. Now, let us analyze the impact of this scheme. Now, the PLI scheme was conceived to scale up our domestic manufacturing capability, which will be accompanied by higher import substitution and employment generation in the country. The government has set aside 1.97 lakh crores under the PLI scheme for various sectors, with an additional allocation of 19,500 crores made towards PLI for solar PV modules in the budget of year 2022-23. As of December 2022, 650 applications were approved under these 14 schemes, and more than 100 MSMEs were among the PLI beneficiaries in sectors such as bulk drugs, medical devices, telecom, white goods, and food processing. The electronics industry in India continues to ascend its importance as its application has become pervasive in the socio-economic development of a country. Electronics, supported by continuously improving communication services, will significantly enhance productivity, efficient service delivery, and social transformation. The domestic electronics industry as of financial year 2020 is valued at $118 billion, and India aims to reach a $300 billion worth of electronics manufacturing along with $120 billion of exports by the year 2023. And it is supported by a vision of $1 trillion digital economy by the year 2025. Improvement in manufacturing and exports over the past 5 years ensures that India is on a right trajectory to achieve this target. Electronic goods were among the top 5 commodity groups exhibiting a positive export growth, while exports in the segment is achieving a growth of 55.1% on year-to-year basis. The major drivers of this growth are mobile phone segments, consumer and industrial electronics. In mobile phone segment, India has now become the second largest mobile phone manufacturer globally, with production of handsets going from 6 crores to 31 crores. And these numbers are expected to improve as more domestic and global players set up and expand their bases in India. Participation in PLI scheme will help more and more domestic players to attain economies of scale in production. Hence, this will further enhance our export competitiveness and increase India's participation in global value chain. The industrial electronics sector is also seeing growth due to improved digitization and robotic applications in Industry 4.0. As one of the earliest ones, the Ministry of Electronics and IT's PLI scheme for large-scale electronics manufacturing saw successful results, with more than 97% of mobile phones sold in India are already made in India. As of September 2022, PLI scheme for large-scale electronics manufacturing has attracted investments of about 5,000 crores and aims to generate about 41,000 additional jobs. In medium term, this scheme is expected to generate 7 lakhs jobs in India. The successes highlighted in the last slide signals that this scheme is leading to the development of a potent ecosystem that is self-thriving and self-sustaining. First, as the PLI scheme focuses on advanced technologies, it is likely to upgrade skills of existing labor force. Second, it will replace obsolete technological machinery and will make our manufacturing sector more globally competitive. Third, the enhanced production volumes cater to increasing consumer demand in domestic market. This can be seen for telecom and networking products, where timely intervention by this scheme enabled a faster adoption of 4G and 5G products in India. Fourth, the PLI scheme in green technologies. India can hence become a pioneer in green policy implementation with a reduced carbon footprint. Fifth, better productivity will create a thrust in free trade agreements that will help India seek better market access for its products. Sixth, an increased sales will demand a better logistical connectivity. PM Gati Shakti plans provide multimodal connectivity to manufacturing zones across India, thus making logistics and operations more efficient. Cluster parks with plug-and-play infrastructure have also been introduced to support manufacturing in different regions. Now, what are the potential benefits that may incur from this scheme? Let us take a look. The first benefit of this scheme is that it increases our strategic autonomy. Efforts have been made to become India self-sufficient or Atmanirbhar in sectors which are of strategic importance. For instance, telecom equipment forms a critical and strategic element of building a secure telecom infrastructure, and India aspires to become a major original equipment manufacturer of telecom and networking products. Second, it will help India in utilizing the comparative advantage. In some sectors, the domestic industry has comparative advantage over other countries, and focusing on these sectors could generate higher returns. For instance, the Indian pharmaceutical industry is the third largest in the world and 14th largest in terms of value. It contributes 3.5% of the total drugs and medicines exported globally. The third potential benefit of this scheme is that it increases the ability to tap high global and domestic demand. This will help satisfy the growing domestic demand in respective sectors, and it will help reduce imports as well as increase our exports to other countries. The fourth benefit of this scheme is that it develops a nascent but high potential sectors. These sectors may not be significant, but in present socio-economic context presents a high potential. The growth of food processing industry leads to better price for farmers and hence reduces the high level of wastage that are prevalent in India. This step is touted as a game changer for manufacturing sector as it is expected to attract foreign players, generate employment in the country, increase exports and consequently integrate our economy with the global supply chain. The success that we have seen in production of electronic components can be replicated in other sectors as well, such as PLI for pharma, food products and drones, telecom and networking components are reporting successes with visible growth in investment, employment and production. Over 600 foreign and domestic firms have been selected across these 14 key sectors in over 2 years, which indicates an enthusiastic industry participation. However, this scheme is not without certain challenges. What are these challenges? Let us have a look. The first challenge that this scheme faces is in designing sector specific incentives. The implementation of PLI schemes in electronic sector and pharmaceutical sector has highlighted that every sector has to have a different eligibility threshold. And determining these different eligibility thresholds is a difficult task. The second challenge that it faces is that such incentives may interfere with natural economic processes. In long run, an economy can become competitive only when sectors can die and be born. Resources get allocated to sectors that see high productivity growth, and an external interference in form of incentives may hinder optimized allocation of these resources. Now the third issue with this scheme is that it disincentivizes the left out sectors. The limited resources in an economy in the form of capital and human resources will be nudged towards incentivized sectors, thus indirectly disincentivizing left out sectors. At a recent review meeting of empowered group of secretaries set up to address the bottlenecks while implementing this scheme, officials have raised concern that there are no common set parameters to understand the value addition by companies that have received or are likely to receive incentives under the PLI scheme. At present, different ministries monitor the value addition of respective PLI schemes, and there is no way to compare two different schemes. Also, there are various deliverables such as number of jobs created, rise in exports and quality improvement, and there is a no centralized database to gauge all these deliverables. The fifth issue that this scheme faces is that the targets for companies to qualify for these incentives are too steep. For example, in information technology hardware sector, until last physical, only 3 or 4 companies were able to achieve the targets of incremental sales in order to qualify for PLI schemes out of the 14 companies that have been approved. Unlike global companies, most domestic companies relied on one or two supply changes, which have been severely disrupted, and these companies hence did not qualify for incentives. Now, what can be done to deal with these issues and further improve this scheme? Let us discuss them in detail in the next slide. The first suggestion is to have a predefined sunset clause on this scheme, as it is not only beneficial for the sector in long term, it will also encourage the individual players to see it as a one-time opportunity for capacity building. The second suggestion is to improve the technological competence. The breathing room created by these incentives could be used by industry players to increase their technological competence and transition towards becoming globally competitive. The third suggestion is to improve the business environment in the country by improving transparency and predictability of the policy framework. For example, simplification of taxation regime or easing the land acquisition process, etc., could become more important for industries which are outside the purview of PLI scheme. Also, there is a need to manage our real exchange rate better in order to strengthen the exports regime. The real exchange rate in India has appreciated by 19% in the last decade on account of both FDI and FPI investments. This appreciation has negatively affected our overall exports. The fifth suggestion is to augment the infrastructure and connectivity by increasing the expenditure on infrastructure creation for improved competitiveness. Regular scheme review to keep track of progress and address concerns over raw material, funds, skilled workforce, payments, etc. are also needed. Further, there is a need to increase investment in innovation, research, and skill development in order to build necessary talent for PLI success. Also, Niti Aayog has commenced work on evolving a set of objective criteria to track value addition by companies who are availing financial rewards under this flagship PLI scheme. Niti Aayog plans to rope up an external agency to design and prepare the database, and this database will capture the value addition, actual exports as against commitment made and job creation. Hence, for PLI scheme to be more effective, it is needed to have a gradual withdrawal of incentives, improving the technological competence of companies, making the business environment in the country better, managing our real exchange rate better, augmenting our industrial infrastructure and connectivity, increasing investments in innovation research, and setting an objective criteria to track value addition will make this PLI scheme more effective.